Welcome back to the channel, everyone. Today I want to talk about whether Citadel really just lost $94.7 billion. I personally actually think they've lost even more, but I want to explain why it's not as simple as just reading the 13F filings. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Malcolm tweeted saying Citadel's 13F filings. In Q4, they were managing $484 billion worth of stocks. Now they're only managing $389. That's a loss of $94.744 billion. Hashtag checkmate. Now, if we look here, we can see from Citadel's Q1 13F filings, their portfolio had a total value of $484 billion. Right now, obviously at the end of Q2, it has only a total value of $389 billion. But as I said in my video earlier, it's not just Citadel taking on these giant losses, it's also other funds like Susquehanna as well. Alex tweeted saying, with everybody looking at Citadel's most recent 13F filings, I thought I'd bring up Susquehanna's as well. From Q1 to Q2, Susquehanna went from $578 billion plus in holdings down to approximately $404 billion. Again, you can see from these filings, it's gone from $578 billion in the first quarter to only $404 billion. As Alex said, that's nearly a 31% drop. But on top of this, it's not just Citadel and Susquehanna. We've also got funds like AQR Capital Management that's also been shorting AMC as well, down from $52.6 billion to only $44.2 billion, a total loss of $8.4 billion. But as I said at the start of this video, I don't think it's as simple as comparing two separate 13F filings. There's plenty of different trades and different securities that aren't disclosed on a 13F filing. But to show you what I mean by that, I want to show you this example from Scion Asset Management. Obviously, this is the fund run by Michael Burry, the same guy that predicted the 2008 housing market crash and is also predicting the current recession. Back in 2020, Michael Burry had around $224 of assets under management. Obviously, through 2021, he made some excellent investments and the fund value ran up to a total of $2 billion. But between the second and third quarter of 2021, the fund value fell from $2 billion to only $41 million. Since then, it's fallen even further to only $3 million. So what gives? As Michael Burry really lost over $2 billion in its entirety in this small space of time, falling from $2.081 billion down to only $3.3 million. The answer is no, he hasn't lost $2 billion, he's just gone from being allocated 100% in equities and 0% in cash to practically 99% in cash and only 1% in equities and stocks. He still has $2 billion, he just doesn't hold this $2 billion in stocks, he's holding $2 billion in cash and only $3 million in stocks, and obviously cash isn't reportable on a 13F filing. Now the same thing could be happening with Susquehanna and Citadel as well. In Q1, Citadel was holding 17,000 separate stocks. Right now they're only holding 16,000, meaning Citadel has approximately sold 1,000 different stocks. Now obviously, as shown by the AQR Capital Management, it's not quite as simple as this. While AQR has sold out of 186 stocks in its entirety and reduced its holdings in 998, it's also bought 151 new stocks and 1,000 new additional purchases. And on top of that, the 13F filings doesn't show how much money has been bought and how much money has been sold, and therefore we can't really deduce how much money has been lost. Now on top of this, Citadel could have also redistributed its portfolio between equity securities which are disclosed in a 13F filing and government securities such as bonds which aren't disclosed in a 13F filing. This is Citadel's financial statements or Citadel's balance sheet, which shows the $72 billion in assets or $1 billion in equity that it holds in Citadel LLC, is $20 billion in equities and $35 billion in derivatives which are reported on 13Fs, and $16 billion of government securities or bonds which aren't reported. Maybe Citadel has sold $94 billion worth of stocks and instead allocated all of that money into US government securities and therefore hasn't lost a singular penny. But actually, I think the more likely outcome is that Citadel has actually sold some of its US government securities and has tried to prop up its equity positions and their short positions, and therefore they've actually lost even more than 94 billion. On top of this, on Citadel's 13F filings, it only discloses their long positions, their call options, and their put options. 13F filings don't disclose their short positions or the money they've lost on their short positions, and they also don't disclose their synthetic short positions or, again, the money they've lost on those synthetic shorts. And therefore, while Citadel's portfolio shows a difference in $94 billion, it doesn't show the increase or decrease in their cash position, it doesn't show the increase or decrease in their government securities position, and it doesn't show the increase or decrease in their short and synthetic short position as well. I think in all reality, when you factor in the synthetic shorts, when you factor in their legal shorts that aren't disclosed in 13Fs, when you factor in their government securities and their cash, I think Citadel has actually lost a lot more than $94 billion. I think if we're seeing funds like Blackrock losing $1 trillion over the last 6 months, I think actually Citadel has probably lost a lot more money than 94 billion. Many funds like Chase Coleman's Tiger Global Management are down 60% so far this year, even if not more. Therefore, considering Citadel manages over $500 billion in total, or potentially over $250 billion, which is disclosed in their Cayman Island filings, Citadel has likely lost 60% of $250 billion, or 60% of $484 billion. Therefore, Citadel has more likely lost more like $200 billion or even $300 billion in total. Now, again, I think the same can be said for Susquehanna and AQR Capital Management as well. As I said, these 13Fs don't disclose shorts, they don't disclose synthetic shorts, nor do they disclose cash or government securities, and therefore these losses are likely minimized. They've likely pumped in more cash from different places into their stocks to make their 13F filings look better than they actually are. Really, we won't know for certain until Citadel releases their financial statements and their balance sheet showing the updated split of equities, government securities, and options. But what we are seeing right now is more and more shorts panicking over what's happened over the last week or two, and they're becoming more and more vocal on Twitter. Thomas Thornton tweeted saying CEOs are now openly buying out of the money calls to gamma squeeze their own stock. $ or hashtag BBBY. Thomas Thornton is obviously shorting BBBY and is salty or angry that the stock has been running up over the last couple of weeks and is looking for somebody or something to pin the blame on. He followed that up by tweeting saying another tweet saying he's buying a public company, moving the stock significantly, and it's a joke. You know what the joke is? The SEC. And as Ragnar Eriksson tweeted, he said even hedge funds are saying that the SEC is a joke. Obviously the dude's losing money and he doesn't like it. Poor baby. Clearly these shorts right now are really struggling. They're really feeling the pinch, they're really feeling the squeeze, and they're having to sell off their long positions and they're beginning to cover their shorts. As I said in my video earlier, these shorts have been adding to their short positions across the wider market, and they're now obviously being forced to cover as the S&P 500 is squeezing. Obviously, these shorts are likely covering their short positions in various different growth stocks, but likely still holding their short positions in meme stocks, as these are the largest short positions and would do the most damage to their funds. But obviously, as I said, over the last week or two, meme stocks have been running up across the board in BBBY, in GameStop, in AMC, and many other meme stocks as well, and it is causing these shorts to really feel the pain. As a result, they're being more vocal on Twitter, they're getting upset with the SEC, they're getting upset with individual CEOs, and they're practically begging these CEOs to issue more equity. Obviously, if these CEOs issue more equity and dilute their stock, it gives these shorts the opportunity to buy these shares at a low price without pushing the price up, as the equity is just being issued. Zero Hedge tweeted this screenshot from a Goldman Sachs report. It says, so going back to the shorts, or rather their squeeze, below is today's Goldman Prime Brokerage summary of the US sector short flow, as seen on the Prime book over the last month. As Goldman explains, negative values equals short covering over the last month in the wider S&P 500. And Goldman's bottom line is that significant and broad-based covers, all sectors were net covered month over month except energy, which means that once we get the inevitable pullback, the flows will go in reverse, and the most squeezed sectors will again be the most shorted, with energy once again coming out on top. We can see that shorts are currently being squeezed over the entire S&P 500, and communication services and technology are being squeezed fairly hard as well. But obviously, as I said, these shorts are likely covering their short positions in smaller growth stocks, not specifically in the meme stocks, as this would do the most damage to their overall funds and would likely liquidate many hedge funds across the industry. It would also potentially crash the entire of Wall Street or the entire financial/stock system, as many funds are currently shorting AMC and GameStop, especially some of the largest funds. Obviously, if Citadel was liquidated, it would do a massive amount of damage to the industry as a whole, as Citadel is one of the largest prime brokers and market makers. But as I'm sure you all know by now, this is their fault for shorting AMC and shorting AMC illegally, and really, they will get what they deserve. On top of that, Hang Loose tweeted saying, so check it. If AMC still has any short interest by the close on Friday, then all lenders of those shorted shares are literally choosing to accept a 50% loss on their positions because they won't get the ape dividend. And that's when they could simply recall their lent shares from those hedge funds to avoid said loss and receive the dividend. Obviously, only the current owner of the shares can receive the dividend, as they can't issue multiple dividends for one individual share, and therefore these institutions can either recall their shares and get the dividend back, or take a 50% loss instantaneously. And Hang Loose said, so why would they do this? He said there's only one explanation, and it's pure and simple collusion. Shorts would have to agree to pay the lenders the difference in that 50% loss because it's cheaper than going out into the market and buying shares to cover at retail's asking price. Obviously, if Citadel goes into the market and tries to buy up 130 million lent out AMC shares, it would likely cause the squeeze. And therefore, instead, Citadel is just paying the pure cash to these hedge funds and is allowing them not to recall their shares. He said this is a coordinated, huge favour that lenders would be doing for the shorts to save shorts from having to cover and potentially bankrupting tons of different hedge funds. And that such would be an indictment of them working together against retail. If it was a cash dividend, then I'd be all the same for shorts to pay lenders the difference, but it's not just a cash dividend. He said this just goes to show how badly underwater these shorts are and how we've been right all along. He said make sure to pay attention to short interest next week and you'll get a pretty good scope of where it all lies. Basically, instead of lenders and institutions forcing hedge funds to buy AMC shares and return the shorts, these institutions are simply accepting cash from the hedge funds instead of the ape dividend. Clearly, these institutions and hedge funds are working together because if they weren't, the institutions would simply recall their shares and start the squeeze. But again, this is just another way for these hedge funds to skirt around the ape dividend and to skirt around buying shares by simply offering a cash incentive or a cash dividend to these institutions instead of buying the real shares. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.